Start. All right, so let's start again. Like I said, how did we get to the, and we're going to look at the ALTA settlement statement, which again, I shared with you a copy of what we'll be looking at today in the chat. There's a link there. I'll also have some screenshots of the sections as we go through it. But the most current form that we're looking at is what we call the ALTA settlement statement. Here's just kind of a little background for you folks who are new to the real estate scene. The most popular terminology that we've had over time has been based on the Real Estate Settlement and Procedures Act of 1974, and we call that RESPA, right? And back in the day, we used, on the lending side, the good faith estimate, and then on the closing side, we used the HUD-1 form, and that would be your settlement statement. The good faith estimate was an estimate from the lenders to the consumers at the beginning of the loan process that detailed what the estimated fees would be to the borrower for generating the loan or originating the loan and closing the loan. It also gave us, the Truth in Lending Act in '68 gave us the Truth in Lending disclosure, which we also used to use in conjunction with the good faith estimate and the HUD-1 later. So again, it's the initial Truth in Lending disclosure would go at the beginning of the loan process, and then at the end, they would get a final Truth in Lending disclosure with their loan package. Now, we don't do this anymore. We don't have that. All of those forms have been combined, right? So this is the old regime. I'm just trying to kind of set up how we got to where we are today. So in, I think around 2010 was the Dodd-Frank Act that gave way to the CFPB, which is the Consumer Financial Protection Bureau. And the act directed the CFPB to combine the forms. So they took the Truth in Lending disclosure, or the new forms are listed there below. So what we came up with, or what that resulted in, and this was sort of, I don't know, mid 2010s, right? We're looking at probably 2015 or so. We ended up with a loan estimate, which was a combination of the good faith estimate and the initial Truth in Lending disclosure from the lender. And you guys should see these if you're working with buyers who are getting financing. Your buyer will be getting a loan estimate from your lender partner at the beginning of their loan process. And again, it's just an estimate of the fees associated with closing the loan. All right. The new forms also resulted in the closing disclosure, which is then a combination of what we used to call the HUD-1 and the final Truth in Lending disclosure. Now the CD, as we call it, or the closing disclosure, is something that we work on with the lender toward the end of the toward the nearing closing. And it is the final settlement statement, as it were, but then we use a simpler form, which is the ALTA settlement statement, and that's what we're going to look at today. And again, the ALTA settlement statement, I gave you a copy. It's really just a simplified version of the closing disclosure, and it really looks like, you know, more or less the HUD-1 used to work or look like back in the day when I got into this business. So if that makes sense, it's just a little background on the forms that we currently have in play. Now, for a cash transaction, you're not going to see a loan estimate or a CD. You're probably only going to see an ALTA settlement statement, or some companies still use the HUD-1 form. It's you know, you're really not supposed to, but some folks still do. So again, the CD and the loan estimate are for loan transactions only, and then if you have a cash deal, it's only going to be a settlement statement. So let's look at the sections in general. I always tell the folks in the office, if you get sort of confused about what you're looking at or where you are on the settlement statement, always go to the headers, right? And on the example that I provided to you, and on the screenshots that you'll see the bolded sections in the middle of the form under the description column, and they're bolded because those are the headers, right? Those describe the subtopics. And so if we go from top to bottom, this is how I like to explain it at closings. You've got general information at the top, right? So property address, buyer, seller, settlement date. Just generally the structure of the document is set up. The seller side is on the left side. So if you're looking at the document, it's on the left side. The buyer's side is on the right side. Now on a regular cash transaction, you're going to have basically 2 columns per party. You're going to have debits and credits. Occasionally on a lender transaction or a borrower transaction, you might have a POC section or column, which means paid outside of closing. And the example that I gave you actually has some POC items, but they're inside the margins, not in a column, which is just fine, but I'll show you those when we get to them. All right, so below the general information, you get your closing costs. And again, top to bottom, just a general description. You've got your deposits, credits, and debits for the first section. You've got prorations and adjustments on that second section. You've got loan charges, other loan charges, and impounds, as well as payoffs. You've got title charges and escrow settlement charges. You've got commissions, everybody's favorite section, of course. And you've got government recording and transfer charges in the next section. And then this one has payoffs, but the payoffs are up above. And then you've got some miscellaneous stuff. And then at the very bottom, that's where the bottom line is. I say very bottom. On your sample, it's at the bottom of page 2. And we'll look at that in detail because people do get confused because there are a few different numbers there. So it's important, again, to look at the header and then look at the description and then follow that description either far right or far left to see what that number is. So we'll look at that in just a minute. All right, so that's an overview. Let's look at each section in detail. And again, please don't hesitate to ask any questions as we go along. So the top of the first page is really just the basic information about the transaction. You've got your title company, you've got your property address, you've got your buyer or borrower. Again, because these forms are designed or were designed for consumer protection, they use a lot of the consumer protection language, which is borrower based. So you may see on a cash transaction a form that says borrower instead of buyer. It's interchangeable. It means the same thing, even though they're not borrowing any money. I mean, we can click a button in our system to change that, but just so you know and don't get confused, it is sort of interchangeable as it relates to this particular form. Now you've got your seller information on there as well. And then you've got your settlement date and disbursement date if the disbursement date is different than the actual settlement date. That should not happen in Florida on a purchase and sale transaction. Sometimes on a refinance, if it's a principal residence, we will disperse 3 days after we actually sign documents. Just a couple tips based on experience. I would definitely recommend that you pay as close attention to this section and all the sections as you do to the commission section. Just make sure that for your client's sake, their names are right, the addresses are right as far as you know. We're human, just like you guys. So as much as we try to get the right information in the right places, sometimes it doesn't end up there. So the more eyes we have on that, the absolute better the transaction is and better the experience is for everybody involved. So again, just make sure you kind of skim over, or don't skim, pay attention. It's not that hard. It won't take you that long to read through it. So that's the general section. That's at the very top. You also have our file number up there. For our system, if you use the file number in the subject of your emails, everything attaches to our files in our system, like you guys use, what's that thing called? I can't remember the software, but you guys know what it is.
App files.
Yes, app files. Yes, thank you. It works very much the same way for us on our side. All right, so moving on, general section, down to the deposits, credits, and debits section. So this is the first section you'll see at the top of the numbers section. And then again, this is how we explain them at closing, and I'll just kind of go through it the very same way. We've got the sales price of the property. Again, make sure that that's correct, right? Again, sometimes we get to closing and we generate a settlement statement. They say, well, what about the addendum that changed the price? We didn't get the addendum. Make sure that the sales price reflects what the parties agreed to. So in this case, we have 245, right? And you see on the seller column, that's a credit of 245. On the borrower's side, it's a debit of 245. So you see how that works. You've also got your earnest money in this section. So this is going to be a credit to the buyer, right, for funds that they've already provided according to the terms of the contract. In this case, it's $2,500. If in the rare instance the seller is holding the earnest money, you would see a debit on the seller side and a credit on the buyer side. In most cases, as you guys may be familiar with, the money is held here, or in some instances with a broker. I don't think that's very common anymore. And in those cases, it's just going to show as a credit to the buyer's side, right? They've already given that money, so they're not going to have to bring that additional funds or those additional funds to the closing. So in this section, you may also see an additional deposit. So if you have, say a post-inspection period deposit, second deposit, you'd see that in here. And then you would also see any sort of flat credits from the seller side to the buyer side. So if you guys are familiar with kind of the government loans, the FHAs, the VAs, things like that, we do have things called seller concessions in many cases in those loans. And that's where you would see the flat credit if it was 3%, 3.5%, 6%, whatever the credit ended up being. That's where you would see it here. You would see it as a debit from the seller side and a credit to the borrower side or buyer side. Make sense? Okay, next section. We're looking at prorations. This is I would imagine, this is probably the most misunderstood section. People who've done some accounting seem to get it better than those who haven't. Just because of the way that the municipalities calendar their collections. But in general, you're going to see here prorations for property taxes and anything that's paid periodically that's related to the property. And those periodic things could be anything from condo association dues, HOA dues, master association dues, anything like that. And then you also may see rents in here. So if you're dealing with a tenanted investment property, we would also make a proration for any rent that had been collected or hadn't been collected. So let's take a look at the example that I have here, and this is let's see, this closed in March of 2019. And so everybody understands how we pay taxes in Florida, right? Property taxes are paid in arrears, right? They're due and payable on November 1st of the calendar year. And then that is good. Let's say it's November 1st of 2020. That's good for 2020, right? Now, that is generally the case for the good for section. What you have in most places here are what we call non-ad valorem assessments that are calendared or billed and collected for on a fiscal calendar, not the calendar year, right? So if you see in the parentheses up above, I do distinguish between the ad valorem and the non-ad valorem assessments. Now this is kind of getting into the weeds. So again, if you have questions, raise your hand or hit me up later. I'm happy to kind of go through it more detailed with you. The ad valorem portion that's Latin for on the value or based on the value of the property. And those are technically your property taxes, right? And those are always billed and collected on a calendar year basis. So from January 1, in this case was 2019, through 12/31 of 2019. Okay. So if you look at the top line of the prorations that I made here on this settlement statement, because we're closing in March of 2019, the taxes cannot have been paid or could not have been paid, right, in March, because we're not to November yet, right? Therefore, in November, the buyer will be responsible for paying the entire tax bill. Okay, does that make sense? Everybody with me so far? Because of that, we prorate the ad valorem portion as unpaid, and then we debit the seller side and credit the buyer side for that portion. Okay, and if you see on the margin, inside the margins, it's broken down. It's a per diem amount from January 1, 2019 to 3/14/2019. And then that 3974.06 is the total amount of the ad valorem portion of the tax bill. Okay, does that make sense to everybody? Kind of get a nod? All right, great. So if you look below that, here is a non-ad valorem assessment, the City of Fort Myers assessment, but it's billed on a calendar year, okay? And so we're prorating it exactly the same. The next line is not a calendar year non-ad valorem assessment. The Lee County Solid Waste Assessment is billed and collected on a fiscal calendar from October 1 to or through 9/30, right? So in this case, for a 2019 or a March 2019 transaction, the taxes or the Lee County Solid Waste Assessment was actually paid through September 30th of 2019, right? So it was paid with the 2018 tax bill. I know this is really stupid and confusing. I don't know why they do it like this, but it's the way we have to explain it. It was paid with the 2018 tax bill and then paid through that September 30th date. And then we are therefore prorating differently, right? Because it's already paid. So we're crediting the seller and debiting the borrower for the time during which the seller paid, but the borrower will benefit from the ownership, right? And again, I'm sorry, that's way deep in the weeds, but it does merit explanation because folks may ask. And then the last one there is a periodic dues proration for March HOA. So in this case, the March Homeowners Association dues are $255.42 per month, right? They're paid for the month of March, and we get that information from the association in the form of an estoppel letter, if you've heard that term before. And then we use that estoppel letter to make these prorations. And in this case, the per diem amount from the closing date through the end of the month ends up being $140.07. Make sense? Yeah, okay, good. All right, next section. Payoffs. Simple, right? If the seller or owner has a mortgage on the property, this is where we account for paying off that mortgage, okay? And again, that's going to be, of course, a debit to the seller on the left there. And in this case, he had a first mortgage of 84. The balance was 84,823.95. So just for the sake of explanation, again, just like we get an estoppel letter from the associations, we also get estoppel letters or payoff letters from the seller's mortgage company in order to generate that number, right? So really nothing to further explain there. Sometimes you might see a credit buy down there on the buyer side, but that's super rare. Again, that would be only in a finance transaction. Most of that payoff section is going to be on the seller side, whether they have a first or second mortgage. That's up to the title work, and then we use those payoff letters to generate that amount. Okay. Moving on. So here is an example of if it were a loan transaction, and we skipped the commission section. I don't know why. Let's see if I have it on here. Man, I wonder if I did that on purpose. That would be rude.
Commission's the most important to all of us.
I know. I mean, I think it was like subconscious. I don't know why I did that. I was thinking about it so much. that I omitted it from the screenshot. So let's go back. On your sample that I gave you, the section after payoffs is the commission section. That's right, everybody's most favorite section. Again, try as we might to get the best information from everybody on commissions and broker fees or transaction fees and that sort of thing. Please give that a once over. Our system generates percentages. Like in this case, if this was a percentage of the purchase price, it will do that. But take the time to pull up your calculator and just make sure that it's the correct percentage, and make sure that we got it right based on the information that was provided to us. Most of your stuff on the commission section will be debits from the seller side for the percentage, right? The commissions payable from the seller side. And then you'll also see those broker fees or transaction fees. I can't remember if you guys do that, Joanna. Are you guys doing a transaction fee or?
Yeah, $2.99.
$2.99. Okay. Yes. Again, just make sure that if you've negotiated those with your clients, that it's on there. Again, we wouldn't omit it on purpose, but it does happen sometimes that we don't get the right information in the right places. So just make sure you give it the once over. So that's the commission section. You see that on your sample. I do apologize for not having it on the slides. It was not on purpose, I promise, because I know it's the most important section. All right, let's back up. All right, so let's say you're dealing with a buyer who's getting a loan. The next section there at the bottom of page 1 is the new loan section. This is going to have a lot of charges ordinarily if the buyer's getting a loan, because there are lots of charges associated with originating the loan. The first thing at the very top is the loan amount. In this case, it's $196, and again, that's going to be a credit to the buyer's side because that's being applied to their cash to close number, right? As I mentioned before, sometimes you're going to see POC items, and if you look at the first two items, the appraisal fee and the credit report fee, those are showing in the margins as POC. And what that means, again, is paid outside of closing, right? So Alan paid outside of closing $450 for the appraisal. Ordinarily, you'll see this, I think most times I see it on appraisals for sure. They'll take a credit card from your borrower buyer to pay for the appraisal fee, unless there's some sort of credit from the lending side. Credit report here is also POC, 8262 by Alan. That just means, again, he paid that outside of closing or upfront, right? And so that charge, even though it's being disclosed here, right, in the margins, it's not being accounted for on the debits and credits, right? So he's already paid for that. So it's not being added to his bottom line. Now, here are a couple things that are being added to his bottom line. It's an underwriting fee here, $13.95. This is basically, like your commission for the lender. And then we've got a couple of other sections. Now, on the closing disclosure, these are going to be broken down into different letter sections, right? So, for example, the origination fees are going to be section A, and maybe some other time we can go through the closing disclosure. And then the escrows and prepaids are going to be in sections F and G. But in this, on the ALTA settlement statement, they're all under just the new loans section, which in my mind is a little easier to read and understand, but I do understand why they did the sections. But so in this case, again, the underwriting fee, we've got flood insurance there, POC. That just means they paid their flood insurance premium prior to closing, which is great. And then what you have here is flood insurance escrow. And so for those, again, who haven't seen the escrows, if the loan is, if the buyer and the lender have negotiated an escrow account, the lender will collect a cushion amount for the escrow accounts. And by escrow account, what I mean is it is an account that the lender has into which the buyer or borrower pays every month a small portion, or a 1/12 of a portion of the anticipated charge for flood insurance, hazard insurance, and most often property taxes. And we see all three of those at play here. If you look at the flood insurance escrow, it's $47 a month for 3 months to the mortgage firm. And all that's doing is padding that escrow account so that when the next flood insurance bill comes due, the lender won't be short, right? When they make that payment, because the lender will then make those payments from the escrow account. So it's kind of like babysitting. You know, the borrower buyer doesn't have to worry about holding the money back and paying it when it comes due. The lender takes care of it based on the payments that the buyer borrower has made during the life of the loan. Okay, so if you look down at the last, or the second and third last lines there, homeowners insurance and then property taxes, those are all also escrow cushions. Okay, so homeowners insurance 3 months at $77.72 per month, and then property taxes 7 months at $376 per month. Again, they're collecting that much because they don't want to be short. And if this one closed in March, they know that come November 1st, they're going to have to pay the full amount of the taxes for 2020, right? And so they're collecting, usually it's like a 3 or 4 month pad to what the actual payment comes out to be. All right, you've got another homeowner's insurance premium there paid outside of closing. So they wanted to make sure this guy paid all this stuff. Sometimes you'll see a premium for homeowners insurance paid at closing, and that's totally reasonable. We send a lot of checks to insurance companies after closings, just based on the fact that the lender requires it to be paid, right? They want to make sure that their collateral is insured, so that, God forbid, if there were a fire or something like that, then the property is insured, and they can also be protected based on the insurance. The last line there is what we call the aggregate adjustment. So this is only applicable if your borrower buyer is getting a loan. The aggregate adjustment is a credit ordinarily. It's super rare that it's not a credit, but it's an adjustment for the over collection of escrows. So there is some crazy formula that the federal government has come up with that says, hey, lender, you can only collect X amount for escrows, right? Unfortunately, if they use that formula on each of the escrows, let's say, for example, the homeowner's insurance, it would end up being some fractional number. So instead of collecting for 3 months of homeowner's insurance, they might end up having to collect for like 1.62 months of homeowner's insurance. So instead of doing that sort of crazy math, they collect in whole numbers, like 3 months in this case, and then they do this aggregate adjustment to credit back the overage, right? So that they don't run afoul of the federal regulation. Okay, does that make sense? That's the easiest way to explain the aggregate adjustment. One more thing that I did not look at, but is a very common occurrence on, or I mean, it happens on every loan file, is the collection of prepaid interest, okay? You see that sort of, I don't know, a third of the way up from the bottom. It's 25.1806 per day from March 14th to April 1st. So just like we pay property taxes in arrears here in Florida, your mortgage payments are paid in arrears as well. So in this case, this buyer's first mortgage payment won't be due until May 1st or wouldn't have been due until May 1st of 2019. And so what the lender does, instead of having them, again, make some sort of fractional payment on April 1st, they just charge them a per diem amount of interest from the day of closing to that first pay, or that, you know, supposed first payment date of April 1st. So that's that. So it's not, there's no principal included in that. It's just per diem, just an interest per diem. And again, they do that so that they don't have to do a fractional payment for their first payment on April 1st. Make sense? Great. All right. Moving along. Title charges. This is my favorite section. I know you guys like the commission section, but this is where I get paid. So we're, you know, you got both sides here. on this particular example, we've got title insurance and endorsements. Endorsements being additional coverages required for the title insurance. Now, most of the time, you're going to see the endorsements on the buyer side, because the endorsements are more often than not required by the buyer's lender, right? Not by the buyer or anything like that. So because they're a loan requirement, they will be charged to the buyer more often than not, if it's a standard form contract that we see, in Lee County. So we've also got closing services, which is just sort of the basic fee for the work we do that's incident to the issuance of title insurance, so the closing and that sort of thing. Search fees, both the title search fee and municipal lien search fees. That's what it costs to get the information from the public record. Those are just pass-through charges for us. We use third parties to generate that information. And then courier and wire fees as needed. Our bank charges us $10 for every outgoing wire. We don't nickel and dime here, so it's not going to be on there if we're not going to use it. Same with courier. In this case, I don't even see a courier fee, but ordinarily on a lender deal, you would have a courier fee for shipping the loan package back to the lender, right? The signed loan package. So just going top to bottom, this is a Lee County deal, and as you guys probably know, customarily in Lee County, the seller will pay for the owner's policy of title insurance, which is on the left here, the $1,300, and then the buyer will pay for any charges related to the lender's policy. And what you see here is a full amount on the left for the $1,300 for the owner's policy, and that's just based on the purchase price, right? And then on the right, you see the lender's title insurance is only $25. We call that simultaneous issue rate, just for those who don't know. So if we're issuing two policies, the owner's policy and the lender's policy at the same time, simultaneously, we will issue the lender's policy at a nominal rate of $25. So instead of charging, if the loan was close to the purchase price, instead of charging nearly double for the title insurance, we do the simultaneous issue rate. On the right side, you see the endorsements, the 5.1, 8.1, Florida Form 9. We can go into those some other time. If you're interested in title insurance endorsements, I'm not sure why you would be. But again, these are just additional coverages that the lender demands of us to protect their interest in the property or in the property rights. And again, these are related to the loan, therefore charged to the buyer. Search fee on the left, wire fee on the left. Again, that would be for the seller's proceeds. So we're going to wire their proceeds. It costs us $10 to do that. We just pass that along. Municipal lien search fee, those are now included in your FAR contracts. Didn't used to be when I got into this business, but that has become a standard cost and service associated with closings. Municipal lien search compared to a regular title search is simply something that checks the permitting sites, checks the utility balances, things of that sort that would not necessarily show up in a just regular title search. All right, and then the closing services at the bottom. Okay, any questions there? All right, moving along. Government recording and transfer charges. So this will be on your second page now if you're looking at the example, but again, here's the screenshot. Pretty simple here. Every time we record a document in the public record, we have to pay the clerk and we have to pay the state Department of Revenue through the clerk's office for documentary stamp taxes and intangible taxes, okay? So you guys, I know you learned all this in real estate school, but just for the sake of repeating it real quickly, the recording fees for documents are by page, okay? So on the top line there, you see a deed, $14.50. So the page count or the page cost is $10 for the first page, $8.50 for each additional page, okay? So in this case, we have a one-page deed, which is $10. The $4.50 additional is for electronic recording. So nowadays we don't go to the clerk's office, we don't send them in the mail, we don't have couriers anymore, we just do everything electronically. The service costs $4.50 for each document that is electronically recorded. So that's what that means. One page deed, electronically recorded, $4.50. Okay. Mortgage, same thing, same page amount, right? $10 for the first page, $8.50 for each additional, plus the $4.50. So $116.50, just, and that's based on pages, right? We could figure that out. So the next line is the intangible taxes on the mortgage. And again, I know you learned this in real estate school, but it's 20 cents per $100 of the loan amount, right? So that 392 number, it comes from the loan amount of 196 times 0.002. That's how you do the math, if you're so inclined to do that math. We'll stay on the right side. The next one is the doc stamps on the note. So again, anytime we record a mortgage, the mortgage secures the note, which is the personal promise to repay the amounts that the borrower is borrowing. And that is chargeable by doc stamps. We call doc stamps on the note, not the same as doc stamps on the deed, which we'll look at in just a second, but doc stamps on the note, and that is 35 cents per 100. So same math, 196 times 0.0035 will get you that 686 number, should anyway. All right. Let's go over to the left. Again, this example is set up in such a way as a customary Lee County deal or customary Florida deal for that matter. Most often the seller will pay the doc stamps on the deed. Everything, of course, is negotiable. That's up to you guys and your clients how you negotiate that. We take the contract and divvy up the closing costs according to what the parties agree to. So on the left, you see the doc stamps on the deed. That is 70 cents per $100 of the consideration or the sales price. Again, in this case, it's 245,000 times 0.007. All right, that's the math there. Those are the doc stamps on the deed. And again, those are just payable right to the clerk. Anytime we transfer the money to an account, they ACH withdraw the money the day after the documents are recorded. And that's how that works. So we collect that at closing and then pay it to the clerk. Any questions there? Okay. We're getting there, almost done. Miscellaneous section, this is really just a, like I said, miscellaneous section. So you're gonna see things like surveys, sort of non-title related payoffs. So sometimes if a buyer's getting a loan and they wanna pay down credit cards, or credit balances like a car payment or something like that. You might see those on the buyer's side. You will see tax payments here. So if the taxes are due and payable, let's say we have a closing on November 15th of 2020, right? From a title perspective, we have to make sure that those taxes are paid, right? Because they have become a lien on the real property. So if the seller, in that case, if we're November 15th, 2020, has not paid the taxes by that date, we will collect for that amount and pay it directly to the tax collector, okay? That's where that would be. Estoppel fees and any dues that are owed, those are, again, the most common things that we see. Just one real quick heads up for you folks who might not have seen it before. Most every community association and management company nowadays will charge for the generation of an estoppel letter up front, right? So what that means is that they want credit card payment up front so that they will then, in order to generate the estoppel letter, which again is a title requirement. That is often a surprise to the sellers we call to get their credit card information. I would love to be able to front the estoppel fees and then just collect them at closing. But if you think about it, let's say 50 closings a month, and let's say the average is $200. That's a lot of money to be out front. In case it cancels, it's much easier just to do that. So if you're dealing with a seller, especially, and again, the FAR bar puts the burden of paying for the estoppel fees on the seller unless you guys negotiate otherwise. So if you're dealing with a seller in a community association, make sure that they just have a sense of what's required of them when they get a contract. They may have to provide some credit card information in order to generate that or get that estoppel letter. Okay, makes sense. We've got utility fees there. So City of Fort Myers utilities. And then we've got things like the association dues, and then a capital contribution, which of course is the sort of one-time payment when you're becoming a member of the association. All right. So really anything, it's kind of a catch-all section, anything that's not related to title charges or commissions or the loan or the recording fees, it's going to be thrown in here as a lump sum payment for us to make at closing. All right. Any questions there? Okay, so I talked about looking at this in detail. The bottom section, it can be a little confusing because there's lots of numbers. Just look again at the heading and then the words underneath the heading. So let's look at that first line, due from borrower, and look all the way to the right on the borrower's section. Give me just one second. Okay. And then if you look on the right there, due from borrower, 53,527.59. So that's their bottom line. That's the amount that the buyer had to wire in this case to close the deal. Okay. You see how that works? Due from borrower. Now, if that is a negative number, like in a weird like VA deal, you might have the buyer getting money back. It would say due to borrower. That's not going to happen very often unless you're dealing with VA usually, or maybe a USDA loan. And then the next line is due to seller. Hopefully all your deals are due to seller, not due from seller. Those are the hardest ones. In this case, the seller is netting. If you look to the left, right, on the seller's columns, debit 145.22 and 57 cents. So they're walking away. They're netting 145.22 and 57 cents. Is that clear? And again, I know it's confusing because I look at it and I'm like, whoa, there's a lot of numbers, right? Why do they have so many subtotals and totals? Just focus really acutely on the language and then follow it to the right or to the left based on which client you're looking at, seller or buyer. Okay. And it happens quite a bit where the the buyer will call us and say, well, you mean I have to wire $252,890? No, it's the line up from that, or 2 lines up from that. So it's really not uncommon for people to get confused, and it's admittedly pretty confusing, but it's what we're dealt with. So so read the language, follow it to the right or to the left based on your client, and you'll be good to go. All right. Any questions there? Any questions in general? That is kind of the soup to nuts version. If you guys feel free to unmute yourselves, and
I'm going to go ahead and just unmute everybody dangerously.
What's that?
I said, I'm going to go ahead and just unmute everybody.
Yeah.
Hopefully not dangerously.
Seems like a small enough group we can handle it.
Yeah.
Hi, Chris.
Oh, hold on,
Hey,
JJ.
you're muted.
I'm trying to unmute her and she's clicking the button at the same time.
You guys keep overdoing each other.
There you go. You're good, JJ.
Okay.
How are you?
Great. I wanted you to weigh in on something that we had happen last week, which I thought was a little silly.
Okay.
When do you, as an attorney / closing agent, consider the property actually closed and title transferred? ? The reason is we had a lovely seller last week who decided he was not going to turn over keys or occupancy or basically the property until the monies that were wired hit his account.
Yeah.
I know, love it. So you wear your attorney hat and your title hat, please.
Yeah, no, it does happen, unfortunately. I think, from an experience perspective, the best thing to do is, I will answer your question, or try to anyway, but experientially, just make sure that, those are questions that you add to your checklist prior to closing. Like, make sure that your seller is on board with waiting for the wire or whatever, or if not, at least and it's not a surprise, right? Because I would imagine in this case it was sort of a surprise that he wasn't going to vacate or turn over keys until he got the wire. For our sake, we consider it closed and fundable as soon as we have all the funds and both sides approve the distribution of the funds, right? So if you've had occasion to work with, an attorney on one side or of the other, even on a cash deal, you see this in Naples or Collier County quite a bit, you'll have to get funding authorization from the buyer's attorney in order to distribute funds and exchange keys. That also happens when you're dealing with a lender. You have to get, sometimes you have to get funding authorization from the lender. But for us, really, as soon as we have funding authorization, we have all the money and we have all of the documents required to transfer title, we are ready to disperse. If you had to, I can't, I'm just trying to think, I'm going to pull it up while we're sitting here, trying to think what, if anything, the contract says about the timing of that. Do you know?
It's a little vague because
Okay, shocker.
Yeah, I mean, it comes right in there because like funds are transferred, so it's who
Yeah.
considers transferring, and we went around with that, but it ultimately comes down to what the property, all the parties agree to.
Correct. Yeah. And it's, and again, if I could, as you grow in your real estate career, make sure that you keep track of those things that happen, and make note of them, and make sure that, again, that they are added to the questions you ask your clients, so that your expectations are set correctly and their expectations are set correctly, and the other side has the right expectations as well. It's just, and it's only basically by experience. You can't, unfortunately, as good as those contracts are, they anticipate a lot of the stuff that we see on a day-to-day basis, but occasionally, like this one, it's going to be a fly in the ointment, and you kind of have to work through it. Hopefully they were able to send the wire really quickly.
We got it done.
Good.
Yeah, successful thing. We've learned that realtors never stop negotiating until even after the deal is closed.
Absolutely.
I do have one more thing that maybe you could address, or maybe you don't want to. When you mentioned the word Naples, and I know you do closings in Naples, when we have deals where the buyer typically pays, what we've run into sometimes is confusion and misunderstanding about what specific parts of all of the title and closing processes actually get paid by buyer and seller. Because we've had some attorneys where they're, okay, well, the buyer's paying for the title insurance, but now the seller has to pick up these other little pieces of it. And I thought maybe we just take a minute or two for some of our agents who are going to sell in Naples, so we don't get side blasted by this.
Yeah, sure. Let me do this real quick. And the easiest way is to show you where to look, and then we can kind of walk through it together. Let me see where I have this form. So as you guys probably know, while I'm pulling this up, I mean, the NABOR contract is different. It is different in a number of ways, one of which primarily and most confusingly is the who pays for what section. And I'm sorry, it's taking me a little bit here. But let's see if, I don't know which one I have that's most recent. So I will tell you first and foremost, the first thing that I tell my people in here is read the contract and understand what it says in the contract. And if you have to read it a handful of times, read it a handful of times, because it is different. It is somewhat confusing, and but it's in there. right?
Call Chris or call me.
Yeah, sure, for sure. I'm going to share my screen again, and I'll show you. Let's see. You guys see that okay?
Yeah.
Yeah. Okay. What I pulled up here was the NABOR contract. This is 4/1/2012. I don't know what the most recent number is, to be honest, JJ. I don't know, but if you, I don't think this section has changed very much. So for one thing to look at, and I have a whole, we can do this some other, again, in depth. I have a presentation on the differences here. One thing to look at is the $150. If the property is located, and I'll try to highlight it so you guys can see it. If it's located in Collier County and the seller fails to furnish a copy of the policy, the seller shall give the buyer a credit of $150. Make sure if you have a seller in Collier County that they have a copy of their owner's policy of title insurance. If not, let us know, and we can help track it down. Basically, we just take the information off the last deed and track it down that way. That's one thing to keep in mind. And then as we scroll down,
Got one. Got my Post-it note.
here we go. So standards E and F, and I believe these, if this is not the most current, I think it is.
I think it is.
I think so. I don't know why it's only 2012, but so standards E and F explain the breakdown of the responsibility of the costs associated with most everything, and again, it just merits reading through it. And so let's look at standard E again. If you get confused, go back to the header, right? So what am I looking at in standard E? I'm looking at sellers, instruments, and expenses. So this is what the seller is responsible for. So seller shall pay for and provide. Now everybody understands what shall means, right? It means they must, right? When applicable, the title evidence or credit specified in standard B2, which is up above. If the property is located in Lee or Charlotte County, the premium for the owner's title insurance policy issued by the closing agent selected by buyer. So that is one thing that often causes some confusion. So what do we know about most deals in Lee County using the FAR bar? The seller will customarily pay for the owner's policy of title insurance, and then the seller side will select the title agent that handles the closing and issues the owner's policy of title insurance. That is only half right in this case, right? The seller will pay for the owner's policy, but the buyer and the buyer's side gets to select the closing agent. Okay, make sense? That can also often throw things for a loop. Okay, second is and charges for title search and title continuation through the date of recording of the deed. So this is if it's in Lee County or Charlotte County. You with me?
Mm-hmm.
Big if. All right. So in that case, it's a lot like what you see in the FAR bar for Lee County deals anyway, customarily. Again, I say customarily because it's not a rule, it's not a law, it's just what we've come to do as a custom. Again, everything's negotiable, but that's what you'll see more often than not. So except for the buyer being able to choose the closing agent, the seller is still paying for the owner's policy and the search charges, okay? Real quick, they'll pay for preparation of the closing documents, estoppel letters, any affidavits, blah, 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 withholding under FERPTA, that's a whole nother topic. Mortgage payoffs from existing lenders. Here we go, doc stamps on the deed, broker's compensation contractually agreed to by seller, utility services to closing date, the full amount of any special assessments from condo HOA, and governmentally imposed liens or special assessments. Now that's a little different. You've got a checkbox on your FAR bar contract for those special assessments. Make sure that's you understand what that means, which are a lien, seller's attorney's fees, and then FERPTA if it's applicable. And then reimbursement of prepaid estoppel fees. We talked about the necessity to pay those up front more often than not. Okay, so that's your seller's side. And then if you look down here, it's your buyer side, right? Again, header says buyers, instruments, and expenses. So here we have buyer shall pay for and provide, when applicable, any, including any sales tax due thereon, recording fee for the deed. That's the same as FAR bar, right? Or non-amended FAR bar. All costs of any institutional loan. So those are your loan costs. And here we go. Here's where we get the most confusion. The premium for the lender's title insurance policy, and so the premium for the lender's title insurance policy we saw in the sample that I gave to you, right? $25 for the simultaneously issued policy. And the charge, wait, where we go? Premium, here we go. And if the property is located in Collier County, the premium for the owner's title insurance policy issued by the closing agent selected by the buyer, and charges for the title search and title continuation through the date of deed recording. Okay, makes sense? So a big difference there. If it's in Collier County, the buyer's gonna typically, unless amended, the contract's unless it's amended, they're gonna typically pay for the owner's policy of title insurance, and they're going to select the title agent that handles the closing. And that's based on geography, location of the property, more than anything. Make sense? It's a really good question. It's a really good question. It causes a lot of confusion. And then, what's that?
I appreciate that. Thank you.
Oh, for sure. I'm just trying to see if there's anything else.
I think it's gotten confused because that where we've seen where they try to shift over like the lien searches and all of that kind of stuff.
Right.
Before.
Yes.
That kind of addresses it a little bit more.
Yeah. I think that
it doesn't talk about warranty deed. And this is really stupid because that's where we've had fights with attorneys as who pays for preparing the warranty deed if the buyer is paying for the title insurance. It's like that kind of stupid
this
question.
is I kind of alluded to Collier County being different in that what we see is what I read up here and what is customary there, I guess. I hate to say there or here, but we are pretty close. Let's talk customary. So customarily, the buyer's side in Collier County will pay for the owner's policy of title insurance and choose the title agent. The seller will then be represented by an attorney who more often than not doesn't do a whole lot of representation. They really just do title clearance and document drafting. Okay, so it's a really strange, like from our perspective, it's really kind of unnerving because as you see here on the seller's instruments and expenses, it says number 3, preparation of statutory warranty deed, bill of sale, estoppel letters, tenant estoppel letters, copies, assignment of leases, affidavits, blah, 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 right? So that section right there demands of the seller or the seller's side that they generate the things that we usually generate as the title company, which are the payoffs, the estoppels, and the documents, right? So in this case, if you have a Collier County deal where the buyer's paying for the owner's policy and they've selected Wingfoot Title, for example, to do the closing and issue the title insurance, we have to rely on the seller's side, usually an attorney, to get us any estoppel letters, any payoffs, anything like that, and draft the documents which will be recorded after closing, right? And so ordinarily we would do both sides, and we can even in Collier County, but the custom in Collier County is to have an attorney or a law office do the seller's side if a title company or law office is closing the buyer's side. Does that make sense? It gets kind of convoluted, but it's just part of it. And if you're gonna do work in Collier County, you might as well understand the dynamic and not try to bucket for any, it is what it is, and you'll end up dealing with more law firms down there than you will up here. But just kind of the way it is. But again, we are happy to do both sides just like we normally do. but the custom there is to have one side handled by an attorney, the seller side handled by an attorney usually. And that again is document drafting. So anything related to the issuance of title insurance. So the deed, the affidavits, things like that. And then they also get the payoffs and estoppels for the seller side as well. So it still confuses folks in here in the office all the time. So it's you're not alone in the confusion.
Very good. Well, I know we run 7 minutes over your allotted time.
Oh no worries. I'm happy to chat. It's always good to be with you guys.
Of that, hopefully some people will use Wingfoot Title for closing, since obviously you are a great closer. And Chris also has other ideas for different webinars. So if there's things you guys have some questions about or you'd like Chris to address, just send it over to Joanna and myself. We'll shoot it over to Chris and we'll create some super fantabulous class for us. Perfect. So thank you again. We appreciate it. And Joanna will all sign off. So
all right. Thanks.
Bye.
Dun 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 dun.